I now hand the conference over to Mr. C.K. Venkataraman, Managing Director, Titan Company Limited. Thank you, and over to you, sir.
Thank you. Thank you very much for joining this call in large numbers. With me here are many of my colleagues, Suparna, CEO of Watches and Wearables Division, Ajoy Chawla, CEO of Jewelry Division, Subbu, CFO, Raj Narayan, CHRO, Manish Gupta, Chief Operating Officer of Accessories and Fragrances, Dinesh Shetty, Company Secretary, Legal General Counsel, Rajeshwari Srinivasan, Chief Operating Officer, Tanera, Shaman Bhaumik, Chief Executive Officer of the Eyewear Division, Nandu VP Finance, Pulkit Srinivasan, and Ramachandran from the Finance Department. Thank you very much once again. It was a very, very unusual quarter for the whole world, I guess, and for us it was no different. The negative leverage obviously kicked in, and therefore the financial results that you see are a result of that, and they hide many things that happened above them. The first is the exceptional manner in which the company rolled out its operations on the safety subject, whether it is for customers, employees, associates, and all that. And we got very, very good feedback, particularly from our customers and also from our employees, for the manner in which we had our standard operating procedures and exceedingly high emphasis on before entering the store, what you had to do, social distancing, norms, wearing the mask, the manner in which the products were actually disinfected before being given to customers and all that. And this became one big thing that customers shared with other customers, and it became a viral thing during Q1. The second thing is that the power of the Titan customer experience and the Encircle program, which must be the biggest program of this kind in the country, certainly, the power of that came into full play with more than 15,000 salespeople across all our EBOs reaching out to individual customers they knew by name and by the deep relationship that they have across all our stores. And those customers came in to buy Titan Company products, during Q1 after the first week of May when things started opening up. And therefore, I believe that our recovery, which was generally constrained by the category codes, were sort of broken to some extent by the advantages that we had in our safety situation, as well as in the love and affection our customers have for us through the reaches of our sales staff. So to that extent, we did rather better than what we had originally thought we would. And in the jewelry category, on top of that, because of the category codes of safe haven, and of course the rising price of gold signaling the potential investment, and people generally feeling a little bit, down and out and buying into jewelry, making them feel better about their future, all these conspired to make our recovery much better. And the whole organization was marching to a beat of cost compression, cash management, and therefore everybody across levels was working very hard to make sure that we came out on top with the least loss and the most cash, and I think we ended up achieving that. And more than anything else, I think the confidence in the future, the resolve in reaching that level that we are setting for ourselves, which is total recovery by Q4 of FY21. I think the whole company, the franchisees, the vendor partners, the sales staff, even the carigars are united in that confidence, united in that resolve to be almost the first company in lifestyle discretionary to come out on top in latest by Q4 of FY21. So that's where we are, and we are pretty satisfied with the results that we have achieved. It's the first time in, maybe 15 years, or more than that, we made a loss, but the world is in a very different place. And in that context, what we have achieved is very, very gratifying to us. And we are also, clearing our mind in this confusing time to stay resolute in, seeing the light there many months down the road. and not being distracted by the storm that is raging around us, not being sort of compressed by the negative emotions that are all around us. And I think we're doing a decent job of that, breaking out of that fog and actually looking at what we need to achieve and not be swamped by the consequences of a possible failure in not achieving whatever we want to achieve. So I think the dice is very clearly loaded in our favor in that sense. And I would think I would be speaking for the entire organization when I say that between the June call and today, we have ourselves gone forward in our minds in terms of our confidence in our future, in terms of our commitment to making that, the goal that appears to be daunting and a little out of line with the kind of categories we operate in actually come about. So it's in a very good place we are in our mind, and that I think is more important than anything else. And of course, all the usual assets and strengths of Titan Company, from brands to networks to customer relationships to supply chain backbones to ethics, will play out in greater level because of the unusual circumstances. Customers are looking more and more favorably at companies which are behaving responsibly. And I would like to bet that, what Tom Collins spoke about, good is the enemy of the great. I would, sort of reverse it in these times to say that great is the enemy of the good, in the sense that we are a good company. And if you recollect Bhaskar's farewell article, so to speak, in the Times of India many months back, he spoke about how a good company can be a great company in terms of shareholder value, whereas the whole good to great was a different take on the whole subject. So therefore, I also believe that the goodness of this company will come to the aid of the company because of customers, because of employees, because of partners, coming to the help of this huge institution that we have created, and it will propel us surely towards the goal of normalcy in Q1. So that's what I had to say. There is a lot of innovation going on across divisions on how do we actually generate desire in people who are continuing to stay at home, where the need to dress up for the office itself is reducing, where there is no socializing in any case. People are doing everything on Zoom calls. In a scenario like this, how do we actually generate demand is a big challenge. A lot of innovation is going on, and if you just look around the kind of television commercials we have been creating, it's a testament to how the company is thinking and how the company will win this battle. The second thing is, on the delivery side, we have taken substantial leaps in our digital journey, from endless aisle to video call to bots to multiple other omni-channel efforts to make sure that when the demand arises, we are in a position to fulfill it to the customer's comfort and convenience. And we're seeing a huge leapfrogging happening on the share of those initiatives to total sales of the company. So through a combination of generating desire and demand on the one hand, and delivering in multiple ways which take into account customer requirements of the current times, we believe that we will win the game that we are starting to play and reach normalcy in Q4. So I will pause here and leave for all of you to ask the questions and go from there. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question, you may press star and 1. First question is from the line of Siddhant Pan from Goodwill Private Limited. Please go ahead.
Yeah. Hi. Hello. Hello.
Yeah, hi. We can hear you now.
Yeah. Hi, Mr. C.K. Venkataraman. My first question was regarding, actually I had just one main question regarding other expenses. we've seen a lot of companies, cut down costs. And you've mentioned in the annual report also, that we're going to cut the costs down dramatically. So why can't we see that in the results, especially the other expenses?
Which other particular expenses are you referring to?
So if you've seen the consolidated results, the other expenses have not gone down as expected. So last quarter they were 439 and it's 406 this quarter.
Yeah, let me extend that. There is this hedging that we do, cash flow hedging as we call it. And during the quarter, there was obviously because of the mismatch in our estimates, original estimates, and our designation of hedges, and the quantity actually being far lower than what was planned before the COVID pandemic hit us. That is what we call ineffective hedges. Ineffective hedges would essentially mean the quantity which is sold less multiplied by the difference in rate, gold rates. Gold rates, you're also aware that gold rates have gone up very, very sharply. So they hit the P&L, that's a substantial amount. If the hedge had been effective, then it would have been adjusted against the revenues. Since it's ineffective, it hits an expenditure account, and that is why the other expenses are high. Normally, whether it is effective or ineffective, it does not affect the PBT as much. It depends, of course, on situation. But in the normal course, the higher cost is also offset by a higher gross margin. Okay, so this is what it is. So therefore, the biggest issue here was the ineffective hedge which hit us in the quarter because of the mismatch.
Thank you very much. Next question is from Avnish Roy from Edelweiss. Please go ahead.
Yeah, thanks. My question is on recovery in July. If you could tell us segment-wise, how is the recovery versus last year July? I understand last year July was also a bit weak because of the high gold prices. Now gold more. So if you could tell us in terms of number of stores and give some indication in terms of revenue, how does it compare to last year July?
Avnish, hi, this is Ajoy Chawla, CEO of the Jewelry Division. In terms of stores, actually July operational days were slightly lower than that of June. While the average stores operational were pretty much comparable, around 90%, but the average store days were closer to 85%. Having said that, June retail recovery was in value terms for jewelry at 77% over last year at a total business level. This is not like to like, this is a total business level. In July, we've had a fairly good number because we preponed the studded activation and the overall activation by a couple of weeks. So we've actually achieved 101% of last year's July in retail terms. This is on jewelry.
And other two segments?
Yeah, in terms of eyewear, I think we had a 12% recovery in the month of May. It went to 23% in June and 39% in July. That's at an overall divisional primary sales level. If I look at the Titan Eye Plus retail chain alone, number of stores in the month of June we had on an average day is to 412. That dropped to 367 in the month of July. However, for the stores that were open in the month of July, we saw a recovery of over 85% of last year's same month.
For watches, the like-to-like stores that were open in July were at 57%. However, the number of stores open in July were actually, in fact, less than June, as Ajoy also pointed out. So, overall, we were at around 40% if you take the total combined sales. And for large format stores, the like-to-like was around 32%. So all retail was around 50% like-to-like.
Right. My second and last question is on watches. The performance has been volatile, and now with work from home continuing for a lot of time more, there's no visibility as such. how do you cater to the demand side? Because in at home, obviously, everyone has access to the time to other devices, and there is no requirement for adornment in work from home. So it would clarify, are you also doing proactive steps like the fashion retailers wherein they are going to housing society, etc. In watch, have you done that?
So for watches, the one big trigger for consumer demand that we are working on and betting on a lot is gifting. And in this situation, in the pandemic situation where everyone is kind of hunkered down at home, and a lot of milestones have been missed, including birthdays, anniversaries, graduations. There are so many milestones and so many occasions for people to celebrate that have actually not turned out to be events. And we are doing a very big campaign called Gift a Titan Smile, where we are exhorting people to gift their loved ones, either who live in their own house or in other cities or in other places, and to reach out to them. So gifting is a very big part of this. The other trigger, which is mainly for fast track, has been actually fashion. And youngsters are continuing to consume a lot of fashion content on platforms like Instagram and social media. And our fashion collections, which we have launched in the month of June, is actually doing quite well. So, and the third brand, which is Sonata, is actually taking a position on the India factor. We are doing a big thrust on India ka favorite Sonata. So there are customers who are wanting to either buy for themselves or for loved ones, and at a lower price point, and they are going into Sonata as their brand of choice. In terms of detailing, yes, there is a lot of effort in calling customers, video calling, making appointments with customers, bringing them into stores, lead generation on the website, which is now coming into, which is getting directed to stores, and store staff are then taking it off. So a lot of omni initiatives, including endless aisle as well as ship from store. All of these are actually leading to good demand generation on the watches side.
Thank you. Just one last follow-up on the hedging. Could you quantify the loss which was there, and anything you can do now proactively to get the loss back, or the ineffective hedging, can that be made better? Anything you can do proactively?
Actually, Agnish, it's very difficult to predict hedging at this point, because when we buy gold on spot, we hedge it immediately. We are required to actually designate a certain month in which the sale will take place. And obviously, nobody anticipated a COVID situation, right? So all these gold that was bought in quarter 3 and quarter 4 last year was obviously, a lot of it was designated to be sold in quarter 1 of this year. Unfortunately, the situation went haywire. And therefore, there is going to be a lot of ineffective hedge which is going to hit us. And then we ended up also rolling over some of these contracts to our subsequent periods. We ended up selling more than what we planned to sell in Q1. So there's been a lot of movement in the actual quantity sold versus the original plan, and then a revised plan as well. Okay, so this has affected us quite badly. The saving grace in a way during the quarter was that we also got stock gains. Stock gains because gold prices have gone up so substantially that we did get reasonable stock gains also, which has in a way reduced the impact of the ineffective hedge. So if you look at your gross margin may look actually better. But obviously the previous person who asked the question on the other overhead is sitting there, the ineffective hedge is sitting out there. So I think in a balance, the ineffective hedge loss that we have, there is some part of which we may regain in the future, but we also believe there may be some stock gains which will also get reversed in the future. So therefore, I'm saying that the numbers may not change going forward. On a quarter-on-quarter basis, there could be some shifts here and there, but overall, whatever results we've come out with is something which may continue for the remaining of the year.
But you are not quantifying.
No, we're not quantifying. Because, as I said, I don't want to do that because it will possibly hit me. Whatever losses I may get from a stock gain of this quarter will hit. See, they will in a way nullify each other. I will get the benefit of the ineffective hedge coming forward in the future, but I'll also get a reversal of the stock gains now. So in a way, they should nullify. That's the point.
Thank you very much. Next question is from Chirag Shah from CLSA. Please go ahead.
Sure. Thank you so much for taking my question. Couple of questions for Ajoy. You had mentioned last time that it could be Q4 before business volumes could go back to normal. Do you still believe that Q4 could be a normal? And what do you think on the competitive pressures that we are seeing on the making charges, particularly given that the informal sector should be sitting on large inventory gains?
Yeah. So I'm hoping that we can get to normalcy even faster than Q4. That's my hope, really. We are seeing good traction as we speak. Even though July achievement is on the back of, let's say, a preponement of the activation, we are hoping that we see it much faster. So yes, I'm still confident that we will be able to see normalcy by Q4. The second point that you said is in terms of competitive pressure. Actually, yes, in the month of June and some parts of July, we did see a fair amount of competitive pressure in terms of promotions, offers everywhere, and particularly so more in South India. We are also seeing that many unorganized jewelers are going through a difficult time. They are not able to replenish their inventory. Even in terms of gold coins, etc., they seem to have shortfall because there is liquidity pressure. We are seeing share gains, both on account of safety and trust, as well as a better product mix that we are able to offer in our stores. So actually going forward, even though some amount of competitive pressures will keep coming up, we see our position actually strengthening. And I would like to also, our sense is that we have actually gained share even in the month of June and July from across both, compared to both the other national chains as well as regional players.
Certainly, that's very useful. And on the second question, can you just highlight what has been the customer response to, let's say, an online sales that you did during the quarter and other schemes like the Golden Harvest and the buy gold and convert into jewelry later scheme?
So we've had very good response to all the digital initiatives. A lot of digital initiatives, both online plus omni or joint closures, as we say, leads passed on by digital onto stores to close. We are seeing it identified it as an important engine of growth going forward. And happy to share that in Q1 itself, these leap forward digital initiatives have contributed to as much as 6% of the total turnover that we have achieved. So these are really, and it's growing fast. Video calling, endless aisle, appointment booking, so on and so forth. So many of them are really caught up well, and we've rolled it out to 250 odd stores out of the 340 odd stores that are there. So overall, yes, very, very positive. GHS has been a good contributor to growth. In fact, the contribution of GHS, which is normally hovering around the 22-23%, or 21 to 22%, we are seeing that this 21% of last year Q1 is showing up as 35% contribution in Q1 this year. And again, in July, it's 32%. So GHS has actually helped us a lot. And we are also pushing strongly on enrollment, though that recovery is gradually catching up right now. So both of these have done pretty well.
Sure. And my last question is on the franchisee support. Have we extended any additional franchisee support for them to navigate the current crisis? And if yes, what are the margin impact on us?
So for jewelry, I'll answer. We've actually extended support to to set of stores which actually were new or very small stores. We were doing it month to month, and later on we've offered a softer working capital loan in order to help them manage their liquidity, largely on their OPEX in terms of people cost or rentals, etc. It is not of a significant amount, and it is not material enough in our P&L as of now.
Sure. So essentially, what you're saying, it's not across the board support, and is there any working capital support also that we have extended?
Yes, we have given working capital support to a lot of associates. Soft loans, very low rate of interest, repayable. Other than the grant that Ajoy mentioned, this is across all our divisions, based on our assessment of need from all of them. The good news is they're actually not requiring so much. That's the good news.
And both on the P&L side and the asset side, they're not material for you to consider them to project anything about the financial performance of the company.
Yeah.
Sure. Thank you so much. I have more questions, but I'll join the queue, and all the best for the future quarters ahead.
Thank you very much. Next question is from Avi Mehta from India Infoline. Please go ahead.
Hi, team. Thanks for taking my question. I just wanted to understand, if you could share the key consumer trends that you've witnessed in terms of stuff that is being sold in jewelry and the gold and the other channel, if at all. If you could kind of give that.
Yeah, sure. Avi, hi, Ajoy here. We've seen a lot of positive sentiment towards gold, both plain gold jewelry as well as gold bullion, that is coins and bars, both on account of investment-oriented minds who are seeing this as an opportunity because of the rising gold rate, as well as from a safety consideration. Many people are feeling it's comfortable to, park in a way, money in jewelry. We are also seeing a lot of, more recently, I must say, in June we did see some wedding purchases. We are also seeing people preponing their purchases for weddings which are scheduled in Q3, Q4 to right now, because they feel that the gold price may become even further up. So that's the second trend, which is linked to the first.
Sorry, this was across gold and diamond, or was this largely in gold?
It's more gold, to be honest. Studded, I think we are seeing, buyer recovery rates between studded and gold are not dramatically different. But the value recovery is seen higher in gold because gold prices have jumped significantly over last year. The other important trend I would like to share is people are buying for milestones, that is anniversaries and birthdays. And we are seeing a fairly good contribution from that. In fact, the contribution in terms of value terms has gone up actually on account of that piece as well. Overall, in the lower price band, there is some amount of sluggishness on gold. Maybe that customer has not yet walked in or still hesitant. But for the mid-price range between the 1 lakh to 3 lakhs, we are seeing a fairly good traction, both for studded as well as for plain gold.
And this you think is not because of your activation. The activations are studded, right? That's why I just want to kind of ensure that this data is not colored by that.
Yeah, no. So this trend is visible across the part of May that we saw, June as well, and then of course even during the activation. So this seems to be linked to the fact that the consumer is the lower end of the consumer in terms of price band is still a little hesitant. The middle end is actually in terms of price points are coming in more easily.
And sorry, clarification, you're 101% in July, right? Of the total jewelry.
Sorry? Can you repeat?
Total jewelry segment, you are 101% of pre last July. That understanding I just want to reconfirm.
Yes, retail sales of last year July to this year July, we are 101%, which is a 1% growth over last July. As I said, it's partly because of advancing the activation by a couple of weeks. And therefore, it may seem a little bit on the higher side, but that's what the figure is.
Okay. And Subbu, just one question on the gross margin side. I was going to ask that if I adjust that 600 crores, you're right, gross margins are expanded. I didn't quite collect, was able to connect what exactly happened in the stock gains. Have you restated your entire inventory to a higher level, which is why there's a substantial amount of stock gains? If you could kind of help and explain that.
Yeah, the way it works, I think we talked about this earlier. create value or inventory on FIFO basis, right? And therefore, older stock gets consumed now, right? That's the fundamental basis of FIFO. With gold prices going up, and that was this sharply, you are bound to get stock gains, okay? Which obviously inflates your margin. Having said that, this quarter we also had significant mismatches in our hedging because of COVID, and that resulted in a very significant ineffective hedge also, which hits the P&L, okay? And that is a part I was talking about, is part of the other expenses, which is that seems bloated, whereas your margin also seems much better. If it had ineffective hedge had actually been effective hedge, it would have been adjusted sales number, so the margin would not have looked artificially high.
No, I agree with that. I get that point. Subbu, what I was trying to understand is essentially the gross margin or the EBITDA margin on an exit basis or a like-to-like basis, because the ineffective portion would be for a larger proportion rather than the stock gain, which will be only for the sales. Given that you've seen the massive decline in sales, that is why I was trying to. Would you be able to help me understand that?
No, you're right. So there is the ineffective gain loss is more than the stock gain for the quarter, but based on our view of how the gold is going, we think it's prudent not to assume that we'll get too much back in the next 6 months or 9 months. Okay.
But is there a number level that you can give that this is what it should trend close to, or a range anywhere of that sort? Just to help understand.
Yeah, I wouldn't want to give a number on this. I would start with this and then say, hopefully in future you should not have an impact. Everything should neutralize each other. That's the way I'll go.
And just
Thank you very much. Next question is from Rakesh Jhunjhunwala from Rare Enterprises. Please go ahead.
Sir, I want to understand that this loss on unrealized hedges, as I understand it, it is a portion of a hedge which, where we had taken in the sales anticipated has been lower than what we had anticipated. Am I right?
You're right.
Right. So, but when I unwind that hedge and I provide for it in a profit loss account, I also raise the value of the gold, no? Right. We hedge it. We don't keep any non-hedge. All our gold is hedged.
You're right. If it were only that issue as only ineffective hedge, you're right, it will reverse. Okay. Whatever loss I book now will reverse. But what happened is because of this unusually high rate, gold rate increase, I've also got a stock gain in the quarter, which is very substantial. But if your stock is varying stock at cost or market price, whichever is lower, no? No, I understand that, but the cost is low. See, you're realizing more than.
I have only one request. All analysts are asking the same question. If you could please send to us a note on what this accounting and what it is. Because as I understand, I haven't hedged gold. Just because this is going to continue for the next 2-3 quarters, at some moment, all that I've lost in ineffective hedges, I will get back into my profit loss account. No?
Overall, you will not have a gain or a loss because the way we hedge between the hedges and the stock gain loss, you should have zero impact on P&L over a period. Unfortunately, because accounting is such, the AS2 is on we are on FIFO there. We get gains on stock when gold prices go up. We also end up having ineffective hedges because of the situation that we are in. And the mismatches are going to continue in the next quarter also.
So that means just because the mismatches are going to continue for next 3 quarters, I cannot assume the loss is permanent. No? At some moment, the loss has to reverse.
The loss on the ineffective will reverse, but the stock gain also will reverse. What gain I get now will also reverse. That's where the issue is.
No, why that will reverse? Because the stock you will sell at the price at which you have sold, no? At which you have valued it. Why will it reverse?
It reverses because the hedges will be at a lower value. It depends on which hedge has got cancelled now.
I think I have a request, and I think most analysts will agree with us, that if you can make a note of this and explain to us an example, we shall be highly obliged. And if you can send it to the exchange. Well, we cannot understand, this is too complicated.
Yeah, we'll clarify. This is a very complicated subject by itself. We'll clarify.
So, if you could please tell us, explain to us by an actual example how this happens, and make it public, put it on your site. It will be very, very helpful to all of us.
Yeah.
Thank you so much, and congrats for a good performance in a difficult situation.
Yes.
My question is, my only assumption is that ultimately there is no real loss because of this loss.
That is right. There is no real loss here. It is only
Ultimately, profit and loss account, debits and credits will set off each other. There are only three differences. So please clarify this by the an example.
very right.
Thank you so much.
Thank you. Next question is from Arnab Mitra from Credit Suisse. Please go ahead.
Very important.
Yeah. Hi, good evening, everyone. My first question was on the mix effect. So, just leaving aside the hedging gain-loss situation, just given the kind of mix trend you've seen in June, July with maybe higher sales of coins, relatively lower studded share, and again, you'll have to probably adjust for that preponement of studded. What kind of a headwind are you facing on the margin side? And are there elements of the P&L that you can use to offset the margin impact, or do you think the lower margin trajectory due to the mix is something which we have to deal with at least for the near term?
I think the margin headwind may remain because the studded ratio is expected to be lower than last year for sure. At least the trends that we've seen so far, and possibly even customer intent, it looks like gold is going to be the preferred jewelry, plain gold jewelry. Therefore, we will see an erosion in gross margin to some extent this year. How much it recovers over the year is something difficult to predict at this point in time. But what we've seen so far, all the activity from June, July, etc., we have seen a fairly reasonable drop in studded share. And we think it may just continue. So it's better to be prudent here on the gross margin side.
Okay, and my second and last question was on this scheme of gold coins where it's kind of a gold protection product for the consumer. So I'm just trying to understand that when this consumer essentially comes back to buy the jewelry later on and returns this gold coins, you would be making a lower margin on that gold because you would be giving him back the making charges that he's already paid. And is this a substantial part of the sale? Sizable part of the sale in the month of June. I just wanted to get some sense on that.
Yeah, so the scheme was that on the making charges that the customer has paid while buying gold coins, to that extent they'll get a set off on making charges for jewelry if they were to buy something before 30th November. Now, we actually had even taken a hit on the making charges in coins and kept it attractively low because we were keen to in a way, acquire customers ahead of time. The total amount is not material. There may be a small payout, but we also think a lot of people will also, there's a chance to upsell. So They may have 20 grams worth of gold coin, but they may land up buying a 40-gram jewelry, or they might buy studded. So there's opportunity for us to upsell. So we are not treating it as material, and we think it can be set off very easily.
Okay. Thanks so much. All the best.
Thank you very much. Next question is from Amnish Agarwal from Prabhudas Lilladher. Please go ahead.
Yeah, hi sir. A couple of questions from my side. First being that we have sold the gold inventory or the bullion worth 600 crores. I understand that there were ineffective hedges and the gains have got neutralized. But can you please quantify if we have made any profit on this bullion sale? That is my question number one. And the second is that in the past, whenever there has been fluctuation in the gold prices, maybe say more than 10-15%, the gold demand has got impacted. So what is the trend expected to be going forward, and how confident are you to sustain the July momentum?
On the gold bullion sale, there's no margin on the sale per se. Having said that, I was talking about stock gains that we got. Since inventories are valued at 3-4, there is a stock gain which comes in, which is not really a gain from the sale of the gold itself. Okay, so I want to just clarify that. Yeah, Ajay.
See, on the currently, normally we are right. When the gold prices spike, customers do get spooked with the gold price. This time round, however, what we are seeing is that it is continuing. In fact, buyer recovery and value recovery for gold is high. The entire growth in value has come out of ticket size, largely driven by gold. So it seems to be that for the moment, customers are expecting it to go up even further, all the way up to season. And in fact, more and more people are coming in and seeking to buy plain gold, both jewelry as well as. So even in August first 8 days, we are seeing a good traction towards plain gold. So far it doesn't seem to have happened. We can't say how it will be in the next few weeks or months. It depends on the gold price spikes.
Okay, and so finally, just a question on watches. Although the sales there also have declined sharply, but the operating leverage doesn't seem to be, you can say, much in our favor, because the losses there are very high, at around say 164 crores at the EBIT level. So any particular reason that the losses are too high, or we are having too many stores which are operated by us, or the manpower and overheads in our factories? Can you give some explanation on this?
Yeah, you're right. It's the operating leverage. So obviously at around 10% of last year's sale, it would be very difficult to cover that kind of high overhead. But going forward, from quarter 2 onwards, with sharper recovery in business, there will be better results. And also simultaneously, the Warren-based initiative we have taken on various cost items will also kick in, and they will kind of emerge better as business picks up.
Ma'am, is it possible to share what could be the break-even level of sales in watches?
It should be in the ballpark of 60 to 70% of the revenues that we normally have. Yeah.
Okay, sir. Thanks a lot.
Thank you very much. Next question is from Chirag Shah from CLSA. Please go ahead.
Bulk of my questions have been answered, but just a quick one. If you can just explain, the studded activation that you mentioned that has helped some number gains in July. And also, Subbu mentioned about the gross margins coming off on account of lower studded jewelry share going forward. But just on the gold jewelry making charges, how versus our usual levels on an apple-to-apple basis, how low are the making charges right now?
Okay, so first on the activations, we usually in July-August period, we run a studded activation. So we are running a similar studded activation of up to 25% off on studded. But this time we have also seen the high demand for gold. We have also given a certain offer on gold as well, so that customers are not disappointed. And many people missed out on buying in Akshaya Tritiya and Gudi Padwa, etc. So we've leveraged that, and and instead of starting last year, we started towards the last week of July. This year we started from 10th of July or something like that. Yeah, so we've actually got a 15-day ahead of last year, and therefore there is some benefit there. So in the quarter, it will even out between July, August, September.
Sure.
What was the second question you asked? I forgot.
On the making charges on the gold jewelry, on an apple-to-apple basis, where are the making charges versus what it used to be pre-COVID level?
Yeah, there is a small dilution, Chirag, not too much, because partly because the gold price itself has gone up, and also there is some amount of down trading in terms of this, greater demand for chains and other slightly lower making charges kind of products. And also between coins and plain jewelry, there is some amount of interplay as well. So there is some amount of dilution, but not too much as of now.
But this has got nothing to do with the competitive pressure, that the informal sector is kind of offering anywhere between 50 to 60% off on the making charge.
Okay, partly because what happens is in many markets, especially small towns, people are still used to getting a making charge in terms of fixed rupees per gram.
Yeah.
So they are expecting 400, 500 rupees a gram. Now, suddenly when the gold price has gone up and they start seeing 1,000 rupees a gram because of the percentage basis, to that extent, yes. And therefore, we have introduced a few KVIs now in the fixed rupees per gram, but bulk of our plain gold is sitting in the percentage itself. So to some extent, yes, that is true, and there could be a dilution on that account, but it may be, as I said, 0.1, 0.2% on the AM, not very material or not very large, that can't be overcome.
Thank you so much.
Thank you very much. A request to all the participants, please restrict to one question per participant. If time permits, please come back in the question queue for a follow-up question. Next question is from Sunita Sachdev from UBI. Please go ahead.
Hi team. I just had one question. I just wanted to find out how is the GHS scheme now trending, and how are consumers now looking at options to kind of invest in this installment facility?
So GHS scheme. So there are two parts. One is, of course, how's the redemption of GHS and sales through that. That has obviously been very high because many accounts were maturing, and a lot of people did want to buy. Not too many people sought refunds. It is similar to last year. On enrollments front, in June it was a little slow. In fact, partly internal, partly external reasons. We are seeing a recovery. We have started seeing about a 56 to 60% recovery in GHS enrollments in the month of July, and that is upwards of what it was in June. And in fact, as an internal measure also, we have focused a lot because we know that this funnel is what will help us in Q1 next year and next fiscal. So we have already started ramping up action on that front. In the first 1.5 months in May and June, it was more about getting sales. But generally, it's good. It's good.
Yeah. All right. And just if I could, the war on waste, the savings initiative that you guys have started, is there any more color that we can get on it, or any number that we can get as what are you targeting in terms of the war on waste?
I don't want to give you a number, Sunita, but the war on waste program is across the board. Yeah, it starts from margins. I mean, it goes to material costs, it goes to discounts, it goes to every element of cost, including employee cost. So employee is not waste, sorry, I didn't want to. But every cost angle is being looked at in the war on waste program. In addition to this, we are also looking at, say, cuts in employee costs, which is happening as we speak. And many of them are something that we are all giving up in a way. So that's basically what it is. It's a large program, and it's also on working capital. It's not just on costs. It's also on capital and cash generation and so on and so forth. So it's all comprehensive plan. So hopefully, and it's delivering as we speak. It's delivering. So it should do better.
Thank you very much. A request to all the participants, please restrict to one question per participant. Next question is from Rakesh Jhunjhunwala from Rare Enterprises. Please go ahead.
Various startup companies have gone into cost control programs like Indian Hotels, especially Tata Motors. Tata Motors has given a quantification of a cost reduction program under each head, and they're reporting in each quarter what they've achieved and what they need to achieve. I think if we give that, it will bring much more transparency and responsibility, and will indicate a management which is batting from the front foot, not from the back foot. So I see no reason why the quantification of the war on waste should not be done with the investor companies, the way the other Tata companies are doing it. Or we are feeling shy to commit ourselves. We don't want to commit ourselves. We don't want our performance to be examined whether what we promised and what we achieved. But that's not how Mr. Chandra is doing it in Tata Motors. They are doing it from the front foot.
Rakesh, we have stuck our neck out and said that we're going to recover Q4 on the sales side.
Pardon?
We have stuck our neck out and said that we're going to recover sales by Q4. So we are batting on the front foot. We take your point. And
sir, you go to the investor call and presentations of Tata Motors. They are batting absolutely. Why don't we have the guts to share with the investor community what our war on waste is? Otherwise, it is just a slogan. How do you know what you are going to do and what you are achieving? At the moment, other expenses have not come down. You don't want to quantify your hedging losses. So we have no way of judging how much efficiency you bought in the fourth quarter in your other expenses. So we want to, say that, sit behind the net, and if you achieve it is okay. If you don't achieve, we don't know anything what you have achieved.
Sure. Actually, Rakesh, you would appreciate that, the Titan management has been very transparent on many, many things, maybe everything over time. So it is not for that.
So it is in accordance with that transparency that I'm asking this.
I understand.
I'm asking that you should make your war and waste public, share it, monitor it every quarter with the investors, because in accordance with your tradition of transparency.
So we'll give it a thought. Yeah.
Pardon?
We'll give it a thought and come back.
Yeah, thank you so much.
Thank you very much. Next question is from Aditya Soman from Goldman Sachs. Please go ahead.
Hi, good evening. So my question's on the recovery that you talked about in 4Q. Now, are you targeting a recovery? Is this just sales, or would you also be targeting a recovery in terms of profits? And just on that, when you talk about recovery, is it sort of getting back to 4Q levels last year, given that, last year's 4Q was also impacted because of COVID. So is it sort of a normalized 4Q that you're targeting, or is it last year's 4Q?
We will look at the base of FY20 Q4 as if COVID has not happened. That is our starting base in a way, and we want to beat that in our 4Q in FY21. And you can see that the losses, for example, in quarter one are clearly linked to the level of sales. So the minute the sales happen, like what I'm describing, the profits will automatically come of that order.
Thank you very much. Next question is from Amit Sachdeva from HSBC. Please go ahead.
Hi, thank you for taking my question. Very quickly, again on this recovery understanding by Q4. See, my sense is that when July is 101%, I know July last year was very weak, so probably that may not be the right benchmark. But given that we are able to achieve sort of 101% of last year level, and we are still in this out of that disrupted quarter, isn't that Q4 expectation of going to pre-COVID level of last year Q4 is too low in expectations, given that we're already achieving this? So are we sort of giving a low yardstick for us to measure and then beat it, or how we should read it? My sense is that we should probably be trying to recover as much revenue lost in this quarter, because some part of weddings which was postponed, will come back in Q3. Probably some of the deferred demand will come back in Q3. Gold price is also high, which will give us a higher ticket sizes, if not anything else. So I'm trying to understand is how we should define your recovery by Q4. If you can give us some guidance how we should think about this in a model, it will be very helpful.
Amit, we are not only a jewelry company. We are a multi-business company, right? And all the arguments, all the points that you just now said about recovery are relating to jewelry. Okay?
Jewelry, yes.
We will certainly, our plan is to actually grow on quarter four of FY20. But the other businesses are in that situation of the category demand from the customer side. So from a consolidated picture, it would be like that. Because for jewelry itself, what you're saying is what Ajoy is trying to do.
So, Amit, I'll also add on to what Venkat said. So as I said, the 101% is on the back of preponing activation, as well as the fact, as you rightly pointed out, July was a lower base last year. And therefore, you cannot extrapolate that for the entire quarter. In fact, we have another method of recovery, which we mentioned earlier on, where we look at like-to-like stores and how do they compare with last year. So in June, we were comparing it to an ADS of quarter one. In July, we are comparing it to an ADS of July plus August, because, the seasonality is different. So if I look at that, we have, reached around a level of 80% if I were to do a pure like-to-like kind of number on many of these stores, etc. So I think, and we are tracking it week to week, whether this 80% will, exit higher in September or no, it's difficult, because September this year is also very unlike last year and other years, because there's an Adhik Maas, and wedding and Diwali is postponed to mid-November this year. So how this whole thing pans out for the quarter two, keeping that in mind, we have we are being a little, cautious and not getting carried away by a July number. But 80% is the kind of like-to-like recovery we are seeing right now, and maybe that's what we will exit quarter 2 at, and therefore hopefully quarter 3 should be better than that. But because of the dynamic nature and many
also this point that Ajoy made about 2 points which are making that 101 actually lower than it is. One is the low base, and the second is the unlike-to-like comparison of the scheme that we did this year. And therefore, the corrected for both these, it may be 80 for July, as opposed to 101 that we are actually on paper. Whereas because August may be a little reverse because of the other reason. Yeah. But with all that, it is some 115 for Q4 for jewelry.
Thank you very much. Next question is from Latika from JP Morgan Chase. Please go ahead.
Yeah, hi. My question was specific to July. Just trying to understand what is the recovery rate for studded. You preponed the activation. How was the response versus what your own expectations? And also your related comment that you believe that some of the gold wedding jewelry sales would have also got preponed as people anticipated gold prices could, run further higher. So if you could just comment on, these two consumer trends. Thank you.
Yeah. So Latika, studded recovery in the month of June in terms of sheer value terms was around 59%. In the month of July, it is around 67%. Yeah, so there is an upward trend. However, when I look at it from an overall perspective, which includes plain plus studded, the same figures were 77% in June and 101% in July. So this tells you a story in terms of both the recoveries have gone up. Now again, the preceding question we answered, whether this 101%, should we read it as 101, should we read it as 80, is difficult to judge, and therefore we are giving you this spectrum. But studded recovery is sluggish compared to plain recovery. However, it is still far better than what we believe the market is seeing. Market is seeing a much slower studded recovery than what we are seeing.
And the wedding sales, has that changed materially between June and July for you? Just related to your comment that we expect you probably would have seen some preponement here as well due to high gold prices. Yeah, so in weddings, see, June actually had some wedding dates as well. So actually, and there was some pent-up demand of, some May, June stuff happening in June. So actually we saw wedding was contributing to about 23% of sale in June. In July, which is normally not a wedding period, last year we had seen 20%, this year we are seeing 21%. And already in the month of August, first 8 days, we are seeing even better contribution for wedding. So what we are seeing is in July, August, we are seeing a greater tendency of customers to prepone, and anecdotally also that's playing back. Because I think gold prices have been shifting upwards quite significantly in the last 5-6 weeks. That is what is kind of driving customers. So yes, we are seeing an increasing contribution in wedding, even though we lost out in Q1, and we think it could become quite large. If the gold prices continue to shift, people want to prepone.
Thank you very much. Next question is from Harit Kapoor from Investec. Please go ahead.
Yeah, hi, good evening. So I had just a couple of quick ones. One was on the exchange ratio for the quarter, and the second was on...
Harit, you're not audible.
Can you hear me now? Hello?
We can hear you.
Yeah. So my question, sir, was on the what has been the proportion of exchange for the quarter?
Yeah, is that the only question? Okay.
Yeah, I had one short one after that, but if you could just help me with this.
Okay. Exchange for the quarter was at 22%. In fact, we've seen it's lower than last year at 30% contribution. And in July, against the 30% of last year, we are seeing a 26%. So generally, because a lot of things keep going up, so they're hesitant to come. And we've also not run too aggressive on exchange.
Got Got it, sir. My second question was on, if you look at fourth quarter recovery that you're talking about, it really implies that, grammage level recovery will probably be closer to about 75-80% odd, while you're, at least on the jewelry business, while value recovery will be full or even better. Just wanted to understand, with the prices moving up, do you feel that proportion of grammage that you're not able to fully recover, is that lost sale, or do you think that will come back in F22 as well? Just trying to understand from a value growth perspective, because that could, if grammage coming back eventually could be a big revenue driver into F22 as well.
People are downgrading on grammage, but managing to still spend more on value. So I'm not sure if that, what is lost, will come back next year. The value has come in. Whether they will buy more grammage, it is very difficult to say.
And I think we are in the business of selling products for rupees. And 1 gram can be 50,000 rupees. 10 grams can be 50,000 rupees is what. As long as people adjust the new gram, new price per gram, actually we should lose customers. It's okay. Volume, damage.
Got it. That's it from me. Thank you.
Thank you very much. Ladies and gentlemen, that will be the last question for today. I will now hand the conference over to Mr. C.K. Venkataraman for closing comments.
Thank you very much, all of you all over the world, for being with us during all times, and I'm sure we will recover fast and surprise all of us.
Thank you very much.
Thanks.
On behalf of Titan Company Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.